Hey everyone, welcome back to Yuri's Box. In this video, I'm going to look at the long-awaited S&P PMI report for the month of March. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So at the headline level, things definitely look better than what was expected. Services was expected to come in at 50.8. We got 54.3, so big beat on the headline level. We also got the manufacturing index, which came below expectations and really slipping back into contraction, albeit slightly. We also got, while we're at it, the Chicago Fed National Activity Index coming up above expectations, although this is February's data point. So, it is what it is. As far as the PMI report is concerned, I see a parallel between the FOMC's summary of economic projections and what Powell said at the podium, and what the headline number of the S&P PMIs say and what the report actually says. Because again, they're telling you two different stories, in my opinion. If you look at the headline number, let's say services, well, it's good news. Beat expectations. But if you actually read the report, there is little to nothing that dispels what we saw in February. Okay, so if you recall, this is February's PMI report. It came out on February 21st. And again, I don't want to waste too much time on February's report. It's all news. But just reading the first paragraph, you expect business activity growth came close to stalling in February. Okay. New order growth also weakened sharply as business expectations for the year ahead slumped amid growing concerns and uncertainty related to federal government policies. Okay, now keep this in mind for what we're about to read and what I'm about to read in March's report. So first off, we start with a slightly better piece of news. Okay, so the U.S. business activity growth picked up momentum in March, according to the survey data, as a marked upturn in service sector offset a renewed fall in manufacturing output. So you had an output in the services sector actually managing to compensate the fall in manufacturing. Okay, moving on. Business expectations, however, for the year ahead fell to the second lowest since October of 2022 as companies grew increasingly cautious about the economic outlook, often citing worries about over customer demand and the impact of aspects of the new administration's policies. Okay, looking at future sentiment, although current output growth picked up pace in March, the decline took confidence to its lowest since October 2022. Barring what we saw last September, they blame the presidential election uncertainty. Moving on, the deterioration in service sector confidence was attributed to concerns over the adverse impact on demand for services and financial markets of federal spending cuts, tariffs, and wider policy changes from the new administration. Okay. Moving on to some of the commentary that at the end of the report, near the end of the report anyway, near-term risks also seem tilted to the downside. Growth is concentrated in the services sector as manufacturing fell back into decline after the front-running of tariffs. Yada, yada, yada. Similarly, some of the March upturn in services was reportedly due to business picking up after adverse weather conditions had dampened activity across many states in previous months, which could prove a temporary bounce. Now, I wouldn't put too much weight in this final piece right here, simply because whenever you read the weather, I mean, the weather seems to be, as far as economists are concerned, a bit of a crutch. Okay, so whenever you see something happen, it's the weather. You relegate it to the weather. You don't know what happened. You just say it's the weather. Now, granted, I don't live in America. I don't know what the weather is like in America. However, usually when I see, the weather being blamed, I tend to be a bit skeptical. Whether it's, bullish for, whatever bags I'm holding, or bearish for whatever bags I'm holding. I tend to disregard, whenever I see weather, next. Business confidence and the outlook also darkened, souring further from the buoyant moods seen at the start of the year to one of the gloomiest readings seen over the past 3 years, largely caused by growing worries over negative impacts from recent policy initiatives from the new administrations. Mostly cited concerns about the impact of federal spending cuts right here, and tariffs. Okay, now this is consistent really with something I highlighted in my previous videos, but I didn't really invent anything. You just read the PMI report, and it's really just consistent with, again, what I've been talking about a lot in my previous videos, which is that as long as you have tariff uncertainty, tariff saber rattling really, and fiscal tightening, somewhat fiscal tightening. Okay, we're definitely off the highs in announcements, and the Doge effect kind of. I mean, it's still acting in the background, but we're definitely off the buoyant announcements that we saw at the beginning of the Trump administration. But in any case, as long as you have these two. These two factors making their effects be felt, really acting in this, making the effects be felt in the current environment, they are going to act as a headwind to growth. Okay, and as long as they continue to persist, expect more of the same. Okay. So really, the number on the headline seems good. Okay, now the PMI report blames the weather, really attributes the increase to the weather in effect. And again, it could very well be. I'd wait for the next PMI again to seek further confirmation. But overall, we see two different pictures. If you stop at the headline number, of course, clear skies ahead. If you read the report, people are telling you two very different things. Okay, well, a very different picture altogether. Now, on the inflation output, on the inflation side of the equation, I think it's worth to point a few things out. Input price inflation accelerated sharply. However, competition limited the pass-through of higher costs to selling prices. Okay, so we have this part of the report indicating that there isn't so much, pass-through to final consumer of these higher prices. However, if I'm not mistaken, here we are right here at the end. Firms' costs are now rising at the steepest rate for nearly 2 years, with factories increasingly passing these higher costs on to customers. Okay, so keep an eye out for this, because if we actually do see that would actually go against something I've highlighted in my previous videos, which is something like the quits rate. Okay, if the quits rate is to be believed, we should not see a lot of, really a lot of pricing power. We shouldn't really see companies have a lot of pricing power. Now, if you do read things like Walmart report earnings, McDonald's, Starbucks, and so on and so forth, they do paint the gloomier picture where consumers are really refusing the price increases. Here, on the other hand, you start to see some of it. Goes on to say, thankfully, from the Federal Reserve's perspective, services inflation remains relatively subdued, but this affects the need to keep prices low amid weak demand, which will harm profits. Again, it's an evolving story in my opinion. So keep an eye on the inflation side of the story. Although again, I still believe it is a growth story at this given time. Simply because, and I'll touch on the final part of the report. Future expectations of the future are really a leading indicator of what will be employment. Because if you're a business leader, okay, and you know that the future is going to be terrible, well, you're not going to hire many people. If you think the future is going to be great, well, you're going to prepare for a great future and you're going to hire more people. As the report says here, employment rose slightly in April, returning to growth after a small decline in February. The upturn was led by renewed hiring in the service sector. However, even here, the rate of job creation was marginal and much weaker than at the turn of the year. Some companies reported job losses due to sluggish demand, plus a wariness to hire due to uncertain outlook. So, again, I don't think this really, this report, personally, it doesn't sway me one way or the other. I just think, it is consistent with what we saw in February. It does not dispel the negative sentiment we saw highlighted in February's report. What we did see is actually things kind of pick up in March, so it looks like that the end of the first quarter will kind of end like with a bang. Okay, now we'll have to see how loud that bang actually is, but in any case, it seems to indicate that we're ending on a high note. And actually, if I remember correctly, right here, survey data are indicative of the economy growing at an annualized 1.9 rate in 1.9% rate in March and just 1.5% over the quarter as a whole, pointing to a slowing of GDP growth compared to the end of 2024. So really, this PMI report, while not terrible, it's not great. And again, it's still consistent with what I've basically highlighted in my previous videos, which is, again, are we booming? No. Are we in a recession? No. We're in a slowdown. And that leaves the door open for negative shocks. Now, that doesn't mean we're going to have negative shocks, but again, it just leaves the door open. And again, I just think it's more of the same. We really didn't dispel anything we saw in February. If anything, we really are confirming the fact that, as I said before in my previous videos, again, tariff saber rattling, fiscal tightening are having an effect. And as long as they remain in play, they will continue to have a negative effect on growth. As far as something like TLT is concerned, of course, prices tanking. We saw, things kind of picked up. We saw a deeper decline. I wouldn't be too surprised if by the end of the day we kind of see some kind of reversal. I mean, simply because if you do read the report, it isn't pointing towards a booming economy, to say the least. Okay, so we could very easily close at what are we now, a 0.8 decline. We could very easily close at these levels or even drop through the bull market support band. And again, I've highlighted that many times, where again, before thinking about higher prices, I would be concerned about this previous trend line. I keep pointing that out because, again, I don't believe we're in the high note of the growth scare narrative. I think that it is a developing story. And so from here till the high point in the growth scare narrative, we're really left vulnerable to short-term price fluctuations, which could actually lead to a backtest of the previously broken trend line. Does it have to happen? Absolutely not. I'll be making a video on the S&P 500 in relation to tariffs and the April 2nd announcement on tariffs. Again, if you feel like watching it, I suggest you do. Again, bonds are going to take it on the chin, of course, because, well, everybody looks at the headline number. Headline number is good, so that's bad for bonds. However, directionally, and that's what I really care about, is that it really doesn't change the direction of things, in my opinion. Simply put, it confirms what we saw in February. We did see a bump in activity in the month of March, granted, but the underlying conditions have not changed, which is kind of like the again, and I'll speak about this in my video about the S&P 500. It is something that could actually lead the S&P to rally further. Okay, so I'll leave it at that. To summarize, headline numbers good, report not so good. We really didn't move away from the underlying fundamentals that were highlighted in February's report. Okay. Again, the headline numbers coming in better will cause short-term fluctuations. But again, as long as you have tariffs and fiscal tightening, it is a developing story. So it will take time to see what effects they have on the economy. So I'll leave it at that. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. I'll see you next time.